Ladies and gentlemen, good day and welcome to the SmartWorks Co-working Spaces Limited Q2 FY26 earnings conference call hosted by Kotak Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Murtuza. Thank you and over to you, sir.
Thank you, Bhumika. On behalf of Kotak Institutional Equities, I welcome you all to the second quarter FY26 earnings call of SmartWorks Co-working Spaces Limited. On behalf of SmartWorks, we are represented by the senior management, Mr. Nitish Sarda, Managing Director, Mr. Harsh Binani, Executive Director, Sahil Jain, Chief Financial Officer, Mr. Prateek Agarwal, Chief Business Officer, and Anirudh Tapuria, Chief of Strategy and Investor Relations. Without wasting much time, I'll hand over the call to Mr. Nitish Sarda for his opening remarks. Thank you, Nitish.
Good morning, everyone, and thank you for joining us for SmartWorks Q2 FY26 earnings call. The earnings presentation has already been shared with the exchanges, and I hope you've had the opportunity of reviewing it. I'll begin with a brief overview of our business and then move on to the key highlights for the quarter. Q2 FY26 marks our second quarter as a listed company, and the benefits of listing are already clearly visible. Operationally, we are experiencing stronger access to supply on preferred terms, which facilitates a faster scale-up and accelerated enterprise inbound activity. Strategically, this market visibility is driving the closure of large deals and significantly deepening our institutional credibility. As the largest pan-India managed office platform, SmartWorks continues to lead India's managed workspace evolution. At 12.7 million square foot of total super built-up area across 14 cities serving 760 plus clients, we've delivered another solid quarter. Our managed campus model sets us apart. As you know, we lease entire bare shell buildings and transform them into tech-enabled enterprise-ready ecosystems that combine scalability, efficiency, and experience. Think of it as a workspace operating system, one that connects landlords, enterprises, and employees seamlessly. Our large amenity-rich campuses are micro-cities of productivity, drawing employees back to work, elevating daily experience, and fostering collaboration. Our performance this quarter reflects continuous strength across 4 key pillars of SmartWorks: high growth, predictable revenue, self-sustaining cash flows, and longevity of the business model. Details of this are mentioned on slide 8. In Q2 of FY26, we delivered another strong performance. Our revenue stood at almost 425 crores, growing 21% year-on-year and 12% sequentially from the last quarter. With this, our normalized EBITDA rose 46% year-on-year to almost 70 crores with a 16.4% EBITDA margin, normalized EBITDA margin. Our committed rental revenue stands in excess of INR 4,400 crores as we speak. Annualized ROCE improves to almost 14.3%, the highest in the company's history, supported by capital discipline and operating leverage from mature centers. SmartWorks remains net debt negative at 59 crores with normalized operating cash flow of 62 crores and an OCF to EBITDA close to 1x. Since our IPO, we've reduced gross debt by nearly 45%, reaffirming the strength of our self-funded asset-light model. I am pleased to inform you that Care Edge rating recently upgraded our rating from BBB plus positive to A stable, a two-notch upgrade that recognizes our balance sheet strength, strong cash generation, and consistent growth. Supply visibility has strengthened significantly, giving us a clear line of sight for the next 2 years and beyond. Today, we have a signed up portfolio of up to 14 million square foot and have visibility of 100% of FY26 and FY27 supply, with FY28 sourcing already underway. Despite having high visibility of FY26 and 27, the company continues to have the appetite to take on more business because of the continued demand. For supply details, please refer to slide 12 and 13 in the text shared. We at SmartWorks continue to beat our own track record of the largest managed campuses, not just in India, but at a global level. Today, over 6 of our campuses are more than 500,000 square foot each. And we are happy to announce that now we have the world's largest standalone campus with the Hiranandani Group in Mumbai. All these large campuses have more than 8 to 10,000 people coming to it on a day-to-day basis. Our landlords base has also diversified, strengthened both in scale and resilience. 24% of our portfolio now comes from institutional developers like DLF, Hiranandani, Tata Realty and Panchsheel, while rest is from non-institutional landlords. It demonstrates strong traction of flexible workspace and new habit formation, which is attracting larger developers also to partner with us. With no dependency on a single landlord, we operate with an unlimited runway and zero choke point, a model built for resilience and not reliance. On the demand side, 2 trends stand out. First, deal sizes are rising sharply, led by GCCs and large enterprise clients. GCCs now contribute to more than 15% of our rental revenue, and this share is expected to continue grow up meaningfully in the future. Our GCC offering, which we will talk about in a few minutes, is uniquely positioned to capture meaningful market share in the future. This quarter, we began reporting our 1,000 plus seats cohort, which means these are clients who have taken up more than 1,000 seats with SmartWorks. This already makes up more than 1/3 of our lease revenue. These large enterprise deals strengthen client stickiness and tenure and are margin accretive. Second, pre-fill from existing clients is driving faster ramp up across new centers. The deep client relationship is our biggest moat. Rentals from multi-city clients continues to be over 30%, which means that if SmartWorks is adding 3 million square foot of space every year, 1 million is being pre-filled from our existing client base. With scale, our acquisition costs are declining, reflecting in brokerage, which has reduced to 2.4% of our lease revenue in Q2 of FY26, and sales cycles are continuously shortening. For instance, the first deal with one of our Fortune 500 clients took 9 months, but every subsequent engagement we closed with them was closed within 2 to 3 months. And today, we've become their pan-India infrastructure partner. We continue to maintain industry-leading cost structures, both for CapEx and OpEx, allowing us to pass on value back to our customers while scaling profitability. I will now highlight some of the key aspects of the industry that we operate in. India stands at the epicenter of the world's office evolution. According to Knight Frank, the country will add 1 billion square foot of office stock in the next 10 to 15 years. At the same time, flexible and managed formats are becoming mainstream. Cushman and Wakefield in its report said that flex penetration in grade A offices has already risen from 10% to 25%, marking a structural shift in occupier behavior. Enterprises are choosing flexibility, speed, and experience over conventional long-term leases. Within Flex, managed campus has become the gold standard, and SmartWorks has pioneered this category in India, bringing design, technology, and flexibility together at scale. a major catalyst in the surge is global capability centers. According to industry estimates, GCCs will drive 50 to 55 million square foot of new office demand over FY 26-27 and account for nearly 40% of the total absorptions across India's top cities. Their preference for managed campuses are natural. These models allow them faster setup, stronger compliances, and scalability, which is essential for them to grow within different cities in India. We're also seeing a broader consumer shift from conventional offices to flex. What started off as a cost and flexibility play has become a behavioral movement. Enterprises now seek experience-led collaboration campuses that enhance productivity and employee engagement. SmartWorks is uniquely positioned to capture this dual shift, from conventional offices to managed models, and from smaller footprints to mega enterprise campuses. Let me now hand it over to Harsh, our co-founder, to take you through some of the key operational and financial highlights for Q2 26. Thank you. Harsh, over to you.
Thanks, Nitish, and good morning, everyone. Q2 FY26 has been an action-packed quarter for us, both operationally and financially. Moving to quick updates on the operational side. Today, our total footprint stands at 12.7 million square foot, with 9.1 million square foot operational across 54 centers, the largest managed office portfolio in India. Today, we manage over 235,000 seats, with two-thirds of our leased area comprising full building campuses consistent with our strategy. Our mature portfolio today stands at 7.5 million square foot, operating at 88% occupancy, with committed occupancy above 93%, providing strong visibility. What is interesting is our sustained and continuously higher occupancy, which reflects the resilience of the business model, which was tested even during the height of downturn. To capture the expanding GCC opportunity, we have launched Smart Vantage, which is a dedicated GCC enablement platform integrating workspace design, compliance, technology, and partnerships. This positions SmartWorks as India's GCC partner of choice, and we expect the GCC revenue to double in the next couple of years. Large deals continue to drive our momentum. In fact, our 1,000 plus seat cohort, which 3 years ago was at 12%, today has tripled to 35% of our total lease revenue. These deals are long tenure, margin accretive, and create stronger client stickiness. Their average tenure is 50 plus months, with significantly higher lock-in. And revenue, 90% of that continues to be from enterprise clients and more than 70% from clients occupying over 300 seats, ensuring visibility and predictable cash flow. Our retention rate during the quarter was 74% compared to 94.5% in Q1, primarily due to a healthy churn from an overall portfolio perspective, as re-leasing has seen higher realizations. For more details, refer to our shareholders' letter. Now coming to the financial highlights, our revenue continues its steady climb with each quarter compounding on prior momentum. Our Q2 revenue from operations stood at 425 crores, which is up by 12% from Q1 and 21% from Q2 of FY25. We aspire to continue growing at 30% plus in the near term. Our normalized EBITDA was approximately about 70 crores, up from 13% from last quarter and 46% year on year, with an overall non-GAAP margin of 16.4%. Our PBT was at around 25 crore, up 40% quarter on quarter, with margin expansion to 5.8% from 4.6% in Q1. Our EBITDA will continue growing faster than revenue, driven by critical scale and operating leverage, while our ancillary business lines eventually will expand it further. Our OCF to EBITDA continues to be very healthy. In this quarter, as a strategy towards our growth, we have added significant new capacity for which security deposit payout has been done. These will become operational in 27 and have had a temporary impact on our OCF to EBITDA in lieu of higher future growth. For more details, refer to our shareholders letter. Pre-IPO, we had scaled up our business in just 500 crores. Our asset-light model continues to prove that efficiency and growth can coexist. Our ROCE improved to 14.3%, nearly double of FY25 levels. We expect this to double in the next 2 years, and we continue to see more headroom for ROCE growth beyond that as well. Our terms of trade continue to be best in class. Our receivables were under 7 days, and we have eliminated any asset liability mismatch for at least the next 2 years. We are accounted by Ind AS 116, which requires us to create non-cash accounting provisions. In the medium term, the reported Ind AS PBT and normalized PBT will also converge as our accounting provisions will start to reverse and business profits increase manifold. To summarize, Q2 just as Q1 has demonstrated consistent revenue growth, strong operational efficiency, and continued progress towards profitability, despite ongoing depreciation and finance cost, which is just optically higher on account of Ind AS accounting. Our operating leverage will now be a key driver of our margin expansion, powered mainly by center-level occupancy gains, which will improve as campuses move from break-even to 80% and beyond to 90% plus. Alongside our corporate and our brokerage cost, both will continue to reduce with scale effect, and this will also enhance our margin. In fact, our corporate cost as a revenue from operation has declined from 13.8% in 22 to 7.9% in H1 of 26. As our new supply stabilizes and we surpass 12 million square foot of mature centers, the expanding base will further enhance margin, with the mature portfolio increasingly driving profitability. At this scale, we expect to transition into self-sustaining capex model, enabling 25 to 30% annual growth without any additional funding. Strong cash generation will continue to support healthy liquidity and cash balances in the near term. Now, giving guidance about our H2 26, our growth looks stronger. We are well positioned to accelerate our revenue growth with several new large deals continuing to go live. This will also translate into expanding margins further in the second half of 26 with operating leverage playing out. Our growth is expected to accelerate also because a lot of our new capacity will mature. So just to give a perspective, we will have 1 million square foot of new operational supply and additionally 1.4 million square foot of our current capacity will mature in H2 26. Our ancillary revenue growth is also set to double, with FAS growing very rapidly and VAS continuing to grow. Every square foot now sweats more revenue, and to clarify on VAS, we only account for take rate in top line for transparency. SmartWorks remains on track to deliver consistent growth, expand margins, and sustain shareholder value. Thank you so much for your patient hearing. We are now open to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Girish Chaudhary from Avendus Spark. Please go ahead.
Yeah, hi. Thanks for the opportunity. And congratulations on the East Bridge deal as well. Just on this, if you can talk a bit about this deal in terms of timelines, the rental cost, the CapEx cost, and also when do you see this to start generating revenues for you?
So, Girish, hi. This is Mitesh.
Yeah.
Girish, the East Bridge property is on a stretch on Vikhroli, which is now becoming the center of Bombay because it's closely connected to all parts of Bombay. We're seeing a significant amount of demand coming in from our existing customers who are also willing to expand. One of the things that we mentioned earlier was that 30% of our revenue comes from our existing client base. More than 30% comes from our existing client base. And most of our growth is now informed by our clients coming back to us and telling us which part of the country or city are they looking at growing in. So we have a very healthy demand for this particular location. This property is currently under construction and is only coming to us in the second or third quarter of next year, which will be handed over to us by the builder by then. The property is about 820,000 square foot, which will have over 10,000 people coming to it on a day-to-day basis. It will require a capex of close to about 110 crores when the entire building gets occupied. Obviously, the entire capex is not going to go up front. It is going to go in phases as and when the occupancy rises up. But if you talk about the demand for the asset, we are seeing the significant demand already getting built up. Since the property is still about 8-9 months away, we are still accumulating those demand coming in. But you will definitely see that the ramp up of occupancy, we typically take about 12 months to mature a center to get to that 65-70% occupancy. This center, you will see that ramp up happen much quickly because of the kind of demand that we are getting from our existing customer base itself. And that's the reason that SmartWorks went ahead and chose, expanding in this location. Hopefully that answers your question.
Got it. If you can talk about the rental costs and the lock-in periods, if you have any details there.
The rental cost is about 120 rupees a square foot. We've leveraged our scale and made sure that we have, gotten a rental which is, attractive in the market considering the 800,000 square foot take up that we have taken. Considering the 120 rupee, approximately 121 rupee rental, it's about a 9.4 or 9.5 crore rental on a monthly basis. The property is only going to get handed over to us in quarter 3 of next year. Hopefully by then we'll have significant pipeline developed already. Currently we have a very healthy pipeline visibility of about 30-35%, which is from our existing customers. But we still have a runway of about 8-9 months before the property even gets handed over to us.
Got it.
And Girish, to add to Nitish's point, we also want to emphasize the quality of demand. 2 interesting trends that have been observed is, one, we are getting mega 1,000+ seater deals. So our conviction on Hiranandani is predicted largely because we also expect a lot more mega deals to help us ramp up quickly at Hiranandani. And secondly, Maharashtra is now emerging as a very key state for GCCs, as we are continuing to see southern states get a lot of demand, but the base in Maharashtra is much lower. So similar to our prior property as well, in Bombay, Navi Mumbai with Tata Realty, we do expect significant GCC inbound demand as well for both of these locations.
Got it. That's helpful. And secondly, just a bit on the retention ratio, which we have seen falling from 90% plus to 74%. If you can talk a little bit about the nature of this exit, and you also mentioned that you've been able to release at higher spreads, but maybe if you can share how much higher and all those details.
Sure, Girish. We have mentioned more details about this in the shareholder maiden letter, which we've also shared. But to provide you a high-level perspective, we do not comment on individual deals, but 2 large renewals ended in Q2, which came from the COVID period. Both spaces have been leased at higher yields, which is largely driving this healthy churn and explains the retention. We expect the retention in foreseeable future to continue upwards of 80-85%, and at the same time, we will continue having some healthy voluntary churn as well in this. Thank you.
Got it. Yeah, thanks.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question comes from the line of Shamit Ashar from Ambit Capital. Please go ahead.
Yeah, hi. Congrats on a good set of numbers and thanks for the opportunity. So a couple of questions from my end. Your IT client mix has declined from around 42% to 40% at present. So considering your recent acquisition in Vikhroli, which primarily houses IT offices, what are your occupancy projections for that center? Secondly, as of FY25, around 18% of your landlords were institutional, and that figure has now increased to around 24%. So SmartWorks traditionally had stronger negotiation power with the non-institutional landlords. So how does this shift towards partnering with institutional landlords impact the overall pricing strategy and economics? Hello? Hello?
Ladies and gentlemen, the line from the management has been disconnected. Please wait for a moment.
Can you hear us? Can you hear us?
Yes, sir. You're
Yes.
audible.
Okay, great. So thanks a lot for the question. So over the last 3 years, the company has intelligently diversified its sectoral base, and today non-IT ITS account for more than 60% of our demand, largely from consumer, healthcare, manufacturing. While IT ITS continues to be a very important part of our portfolio, what we've recently also seen is influx of a lot of GCC clients, which are now more than 15% of our revenue. So we expect that the Vikhroli campus will ramp up quickly on back of a strong pre-leasing demand and also our sectorally diversified base, which not only includes IT ITS but several other more sturdier sectors. Prior to this, SmartWorks had not expanded very aggressively in Bombay as we were building our brand. And Bombay, as you will notice, has a lot of BFSI and headquarters, which typically take a little longer to convert. But we are at that juncture now where we will continue to see a lot of headquarter conversion, and also we will penetrate more deeply into the BFSI segment in Bombay with both the new campuses that we have recently leased.
And just adding on to that and to your second question of institutional developer and partnering with them, I think, for the longest time, SmartWorks with its large campus platforms used to take from just non-institutional landlords because the brand visibility wasn't there. Now that the brand visibility is there and increased significantly, we are seeing even large developers, partnering with us and giving us the kind of deals that is required for SmartWorks to take up the entire campus and giving us their inventory as well. So you're seeing these numbers go up just because the institutional developers have also started partnering up with SmartWorks as a model instead of just giving us a floor or any other flexible workspace or floor, giving us that entire building ability to create the campus that we have been able to successfully create on the non-institutional side. So I think that is a very positive, outlook because they are opening up to our model. And in terms of financials, obviously we have the ability of negotiating now with scale, and we're seeing the same sort of numbers that we are able to achieve on the institutional side as well.
Got it. Thank you.
Thank you. The next question comes from the line of Yashovardhan Agarwal from IIFL Capital Services Limited. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir.
Yeah, hi. Thanks for this opportunity, and I hope you all are doing well. So a couple of questions from my side. If you could explain the overall cycle of styling and operating a new center, let's say from signing LOI to occupying it, leasing it to our customers, how much time does it take for us to reach the break-even occupancy and then for that center to reach the maturity? And relating it with the cash flows as well, that at what stage, how much cash is required? If you could explain that, please.
Sure. Absolutely. So we typically take a building about 5-6 months before the building is completely ready. Since SmartWorks is coming and taking up large individual buildings and converting them into campuses, we do not look at a floor in a building or a part of a building. So the decision to take a building first is driven by the demand from our existing client base. About 30-35% visibility of the building's occupancy comes from the pre-demand that we have for that particular location. So we go ahead and only sign that building once we have that demand in place. Once we take up a building, usually 5 to 6 months before the builder is ready to hand over the space, we sign the LOI. We start, preparing the entire documents for the building, the entire design deck, tech enablement, and start marketing the asset to outside our existing customer base as well. On the day that we take up a building, the journey is on the first month. It takes us about 4 months to do all the construction of the common amenities. So we'll build out the cafeterias, gyms, your lounges, all your collaboration zones, sports zones, all of those amenities that you see in a SmartWorks campus will all be built out in the first 4 months with the pre-occupancy, which is already committed on a building, which is typically that 25 to 30% mark, at least, which starts in the first 4 months itself. From there, the journey is a 12-month journey to get towards maturity. Within the first 12 months, we get to about 65 to 70% occupancy. We break even closer to about 60% in occupancy. So within the first 12 months, we get to that 65-70% occupancy. And on an average, over the last few years, we've ramped up to about 90+% occupancy in 14 months. That's the journey that we've seen on an average for most of the centers in the last 2 to 3 years. If you look at that trend, because of the brand value that SmartWorks has created and because of the larger customer base, which is now expanding further and further, we're seeing that pre-fill is happening much quicker and quicker, allowing SmartWorks in its unique model to take up even larger buildings because we're able to fill it up with our existing customer base or with 1,000+ seater deals. If you see, Harsh had mentioned that 35% of our revenue comes from customers who are taking 1,000+ seats in an office. It means that once they come and commit to these 1,000+ seats, our occupancy ramp up happens much quicker. We are a pioneer in this. If you look at our total footprint, despite having a footprint, the largest footprint of close to 10 million square foot, almost 10 million of operational footprint today, we only have 760 customers in occupying those spaces. So it means we're taking these large campuses, but we're also filling it up with large, sticky enterprise clients who are committing to much longer tenures, making sure that this model is more sustainable and predictable.
Got it. So pretty much helpful. And so you didn't mention the cash flows part that when and where do we do the CapEx and the security deposit? So could you please address that as well?
Sure. So we give a token deposit, security deposit, usually 6 months before, 2-3 months before the handover is supposed to happen. We give about 1 to 2 months of security deposit to the landlord, and then on the handover, the remaining amount of security deposit is given. The security deposit is given, for the entire building on the day of the handover, which is typically on a normalized about 3 to 4 months for SmartWorks on the total rental for the building. So if you're taking a building, say, for 100 rupees, we give 300 rupees of security deposit, 300 to 350 rupees of security deposit on day 0 when the builder hands over the space to us. We then spend on the common amenities, which is typically 10 to 12% of a building, and the pre-committed space, which is about 25-30% of the space. So 42% of the entire capex goes out within the first 2 to 4 months of the property being handed over to us. So if we're taking an 800,000 square foot building, we will deploy that initial 40-50 crores to do that entire capex for that building in the first 4 months itself, which is for the common areas and the pre-committed clients which are there for the building. After that, we only build out the spaces once a client comes and commits to the spaces within those buildings. So we don't pre-build and keep any inventory. We only build it out as and when the client keeps coming in. So the capex outlay is actually distributed. When the client is coming and committing to SmartWorks, they also pay us a security deposit. So on the security deposit arbitrage, SmartWorks actually negates the security deposit that we pay to our landlords. In fact, we get some top up on that from the clients that come to us. And since we are only building out the space after the client has signed with us, they pay us the full security deposit even before we start construction. So we are able to manage our cash flows by doing that.
Got it, sir. Thank you. Sir, in the initial remark, you mentioned that asset-light model is helping us scale faster. So could you please touch upon that as well? Because I think 100% of the capex we are doing it, and it's just a straight-lease model. So what is asset-light in that?
So the asset-light, we mean, sir, that because we are not going ahead and buying these buildings, the capital which is required to be invested on capex is only the 1,300 rupee capex that we typically do to build out the interiors of the office spaces. That is only a fraction of the cost of the building. Because of our scale, SmartWorks has been able to reduce our capex outlay significantly, which is one of the lowest in the industry, and without compromising on the quality for the customers, looking at the kind of customers that are coming into the SmartWorks ecosystem. Because of this ability, we've been very, very capital efficient. If you look at our growth, pre-IPO, we've only spent 500 crores in equity that we've raised to build out the entire and expand the company to be over 1,370 crores in revenue last year. This year, we're already seeing a significant growth in the first quarter, growing from 680 crores year on year. Last year, H1 was 680 crores. We're touching 800 crores already in the first quarter of this year. So that asset-light model of is because our capex spend is so low that we are able to deploy with less capital, increase our footprint significantly, and we're not buying any of the assets.
Okay, now thank you. So if I'm looking at your cash flow, I think it is around 186 crores of the capex that we have done in the first half. So for how many seats would that be?
Thanks a lot for that question, Anirudh this side. As far as the capex deployment is concerned, we are actually given a detailed breakdown on page 35 of our investor presentation that how are we calculating the normalized gross block. And when you look at our normalized gross block, our H1 FY26 footprint was approximately 9.1 million square feet. So for 9.1 million square feet, our normalized gross block stands at approximately 1,400 odd crores. And this includes maintenance capex as well for the centers which are actually completed around 3 years of tenure.
Okay, so okay. Thank you for that. And if I may ask one more question. So that is on the margin side. So currently we are expanding very fast. So I think there would be the effects or impact of the new centers which are coming up as well, which are not mature yet. So sir, if I'm looking at SmartWorks, so on an optimum basis, at a center level, what are the EBITDA margins that we could be making, we are making, and post all the corporate expenses as a business, what could be the margins that we could be making?
From a center level EBITDA margin perspective, what you actually disclosed is around a 16.4% kind of a corporate EBITDA margin. If you look at our corporate cost is around 8%. So from a center level EBITDA margin perspective, you can actually add both of them and it will come to approximately 23 to 24 odd percent. That is the range where we are actually operating on a center margin level.
And to add to Anirudh's point, that is at an overall level where the mature center margins are higher than the overall blended margin because there is an initial period where the new centers pull down the margin as they ramp up and become mature. So on a steady state basis, while we continue at a high growth pace, adding 2.5 plus million square foot every year, we expect that once the company hits the critical scale of 12 million square foot, which is going to happen in a year and a half from now, at that point, the denominator of the new centers will not likely pull down the overall margin, and you will continue to see margin expansion happen in the subsequent quarters because with increasing scale now, operating leverage is playing out well, both at a center level and we continue to see efficiencies post-IPO, both on our corporate cost as well as our brokerage cost, both of which will reduce as a percentage of our revenue and also enable us to expand our margin. We've disclosed more of the details in our shareholder letter as well.
Okay, sir. Pretty much clear. Thank you for taking my question.
Thank you. The next question comes from the line of Shiv Kumar Prajapati from Ambit Investment Advisors. Please go ahead.
Hi, sir. Thanks for giving me the opportunity. So, sir, my first question is on the GCC front. So, right now it forms around 20 to 25% of our overall flex space, and obviously going forward, as you highlighted at the initial as well, it would form around 35 to 40% of the overall flex space. So just wanted to understand, are you putting any special, any specific plans to capture this demand going forward? And if you could explain me, like these GCCs are largely belongs to which sector? Is it BFSI, IT sector, or some other sectors?
Certainly, thank you for the question. GCC is a core area of focus for us, and today it accounts for more than 15% of our revenue. Interestingly, the GCCs are not limited to only ITS clients. We have a very well-diversified client base, which also includes BFSI, consumer, manufacturing, and healthcare. And we are in fact seeing GCCs across the board in these sectors as well. We had mentioned that we expect the GCC revenue to double in the next couple of years. Keeping that vision in mind, we have launched a new product called SmartVantage. What we are increasingly seeing from GCCs is that they prefer a one-stop solution where the offering is not limited to workspace, but also takes care of their other needs, including onboarding, legal, compliance, and taxation. So we've added significantly large partners who are able to deliver this core service as well, and together with them do a joint GTM where all the needs, including staffing and workspace, get taken care of by GCCs. And we also today have presence not only in Bangalore and Hyderabad, but we are truly a pan-India player. Our top 6 cities contribute more than 80% of our footprint. So in markets such as Gurgaon, Noida, Pune, Bombay, where we are runaway market leaders as well, we are continuing to see a lot of inbounds from GCCs. And therefore, this is going to be a pan-India multi-partnership model, which will help us double this revenue in the coming years.
All right.
Mr. Shivkumar, I'm sorry to interrupt you, but can you please speak through a handset?
Yeah, am I audible? Is it better?
Yes, sir. Yes, sir. Now you're
audible. My next question is, would you be able to share about the nuances zone-wise or city-wise? Just want to understand, is there any supply constraint or, saturation in the market that you see going forward? And if you could explain us, like, which zone or city is more challenging to operate, something like that.
So if you look at our strategy, this is Mitesh in India, I can take this question. If you look at our strategy of taking large individual buildings, what makes our model very unique and scalable is the fact that for SmartWorks to grow at 2.5 to 3 million square foot every year, we need to add 5 to 6 buildings, considering the average size of buildings that we're taking now is 400 to 500,000 square foot. So in terms of supply, just because of the conscious choice of taking large format buildings, our entire portfolio today has over 12 million square foot with less than 60 centers, which means that these assets are large campuses, which allow us to create an entire ecosystem within these buildings, which is paralleled by none, right? We have this ability of creating a large gym, creches, cafeterias, all for our customers, which can be standardized for their requirements across the country. We realize that with this model, we have the ability of actually scaling in any part of the country. We currently are tracking multiple assets across different cities, and wherever we are seeing the most opportunity with respect to demand coming from our existing client base, that is where the maximum amount of capital deployment is going towards. In terms of city growth, we're seeing opportunities coming from almost all tier 1 cities of India. The top 9 cities are seeing a significant amount of growth. If you look at our trajectory, with only 500,000 square foot of space in Mumbai up till 4-5 months back. Today we have scaled up from 500,000 square foot to almost 2 million square foot of space just in the region of Mumbai. So we're seeing a significant amount of demand coming in even from mature cities where supply might be less, but because of our unique ability of taking up large individual buildings, just with 2 or 3 buildings, we've been able to scale up that entire operations from 500,000 to 2 million square foot. So supply is not a challenge for SmartWorks. When it comes to demand and cities where most of this demand is coming from, we're obviously seeing the developing cities seeing a significant amount of demand coming from cities like Pune, cities like Hyderabad, Bangalore, Noida, Chennai, which are in the development stage. More mature cities like Bombay and Gurgaon, there is some sort of a supply challenge there. But in terms of demand, there is a significant amount of demand coming from these mature cities now because the supply is fairly limited compared to some of the developing cities. But with our unique model, we're able to solve that supply challenge.
Got it, sir. And then my question.
Mr. Shivkumar, I'm sorry to interrupt you, but please rejoin the queue for your follow-up questions.
Thank you. Thank you.
Thank you. A request to all the participants, please restrict yourself to 2 questions only so that the management is able to answer everybody's question. Should you have follow-up questions, please rejoin the queue. The next question comes from the line of Vandit Jain from Sage One Investments. Please go ahead.
Hi, am I audible?
Yes, sir.
Yes, please.
Yeah. So my first question is around the cash flow. So since we have seen a high cash outflow due to security deposit for the East Bridge center, now when we get the security deposit from the customers, does that happen when the demand commitments come in, or does that happen when we get the center, let's say in Q3 FY27? So when the cash inflow of it is expected to happen?
So that also typically happens 2-3 months before we even hand over the project to the customers. Usually the deals with the customers would get signed closer to the handover of the building before we start deploying our capital. Currently, the capital outflow or the money which we spend is only towards the security deposit that we've given for the building. Once the existing customers who are looking at the building sign up the building closer to probably 3-4 months before we hand over the building, they give us their security deposit. So you'll start seeing that inflow coming in much before we start spending on the fit out for the client. So there is a little bit of a mismatch just because we are now looking at blocking supply for FY27. For most of these years, the pre-IPO, SmartWorks was looking at growing at a pace in which we were blocking the supply only for this year. Now, with our scale and with our ability to take these large campuses, we're not only blocking supply for the same year, we're going ahead and blocking supply for the next year. So since our IPO, we've gone ahead and signed more than 2.7 million square foot of space. And that is where some of the security deposit outflow has gone towards. But you will start seeing realization of security deposit 3 to 4 months before the property is handed over to us by the landlords. And much before we start spending towards the capex for the customer.
And to clarify and add to Nitish's point as well, the security deposit is not specifically only for Hiranandani. In the quarter that has just gone behind us, we've added and paid security deposit for more than 2 million square foot. And as Nitish has clarified, that the entire security deposit for properties which are going to get handed over follow a time-based milestone approach. It's not paid out on day one. It's paid over a period of time. While there is a mismatch, that mismatch is also offset with a lot of demand security deposit which also starts to come. So just wanted to clarify the 2 million square foot point which has driven the security deposit outgo in light of the immense growth opportunities that we are seeing ahead of us.
Got it. Understood. And my second question is around the blended occupancy level. While for mature centers, you mentioned it's around 88%, but at blended level, it is down to about 81%. So any color on that and any indication going forward how we should see that number?
Sure. No, thank you for that question. We have mentioned more details about it in the shareholder letter, but the 81% is overall at a blended level where the denominator is also playing a factor because we've added significant capacity, which has brought it down. Our mature centers today are at 88% with a committed occupancy of 93%, and our overall committed occupancy is also close to about 87% plus. So that's the sort of visibility we already have today. And the occupancy which is unique to SmartWorks is the fact that we not only have a higher average occupancy, but the occupancy remains high for a sustained period of time, providing a high level of visibility in terms of our revenue and cash flow. Hope that answers the question. Thank you.
Got it. Thanks.
Thank you. The next question comes from the line of Vikrant Kashyap from Asian Market Securities. Please go ahead.
Sir, good morning. My first question is on your churn. So you did mention that your churns are higher and you would see a healthy churn going ahead, and these are related to your COVID time occupancy. Just wanted to understand that does this churn is been opted by you to let the client go, or the client decided not to renegotiate the rental at the current levels, and how's that deal happened? And even if we are going to see healthy churn going ahead, and so when this occupancy will come up and this retention rate will come to our normalized run rate?
Sure. So if you look at our churn, the churn stand at 74%, but if you look at our committed occupancy, as Harsh has already mentioned, for these centers, they are already at about 87-88%. So while these churns have happened for clients who signed up with SmartWorks back in 2020 and 21, because we have a 4 to 5 year tenure with most of these customers, this is a voluntary churn that SmartWorks is doing for customers who are paying at a number which is below what others are trading at in the market today, or other customers or SmartWorks are paying in a particular building. This churn is going to happen. This voluntary churn is a good churn for the company. You'll see this happening over the next few quarters, because a lot of supply of clients specifically which were done during COVID, during the first 2 phases of COVID, are all coming up for renewal at this point of time. So clients who are willing to expand or willing to increase the pricing and get to today's level, we're going ahead and renewing with them. But then there will be certain portions of clients who have scaled up significantly, and economically it might not make sense for them to be in that particular location. We're also trying to see if we can take those clients and move them maybe to a different location in the city and reduce the cost for them. But you will see that typically over the next 2 to 3 quarters, because it is a time frame which is 4 to 5 years after COVID, you will see this churn coming in, because there are some deals which have happened in COVID which will get churned out currently. Either those clients will go ahead and pay more, or they will be shifted to a different center, or they will downsize. In all these 3 cases, you will see that churn number getting impacted. But with that, you should also look at the committed occupancy. The committed occupancy stands at 88%. So it means that even if the client is churning out, we are immediately finding a different client to come and take up that space.
Yes. Thank you for the clarification. 2 more things. One, your other operational revenue has doubled compared to last quarter. So can you please give us some details of the components of the revenue, and are they sustainable? And my last question is, you have just reduced your number of city presence to 14 from 15 in the scenario where every player in the flex in this space is increasing their presence to multiple cities. So what is the rationale behind that, and how should you look at your expansion into newer cities? Thank you.
Thanks a lot, Vikrant. As far as the detail on other revenue is concerned, in Q2 FY25, our other revenue stood at approximately 28 odd crores. It has increased to 45 odd crores in Q2 FY26. Out of this 45 odd crores, revenue from FAST services contribute to approximately 20 odd crores, and revenue from ancillary services contributed approximately 25 odd crores. Vis-a-vis, the same numbers in the previous year were 16 odd crores for revenue from FAST, and ancillary was 12 odd crores.
Okay, so these numbers are sustainable?
These numbers are absolutely at a significant pace. With the, if you look at these numbers, they have already, grown by 25-30%, and we are seeing these numbers over the next few quarters is in fact going to expand even more.
Okay. And clarification on your contraction in the presence of city. That will be helpful. Thank you.
So the presence of cities also depends on the kind of traction that we are getting. You're seeing us increase our footprint more and more in tier 1 cities. We were in a situation where in one of the tier 2 cities, the building that we were there in could not allow us to scale further. So we have gone ahead and started, looking for buildings which is much bigger in size. It is one particular building in Jaipur where we wouldn't have a scalability option, where we have to move into a larger individual setup, and that's why you will see that reduction. But in fact, in the coming few quarters, you will see us increase our footprint by getting into a couple of other tier 2 cities as well.
Okay, thank you, and wish you best of luck.
I just wanted to add one more aspect as well. The city which you see, Jaipur, which Nitish mentioned, that contributed just approximately 49,000 odd square feet.
Okay. Okay.
And just to add to the FAST guidance also that we have, if you look at last year, complete year, we were total, I think, and Anirudh, correct me if I'm wrong, about 20 to 25 crores of revenue from that business this year. In the first half itself, it scaled up to about 40 crores. You will see this number scale up over the next few quarters, and there is a FAST guidance which we've also given in the presentation.
Thank you, sir.
Thank you. The next question comes from the line of Ayush Sabu from Choice Institutional Equities. Please go ahead.
Yeah, congratulations on a robust set of numbers on the new deal side. Could you just throw more light on the Smart Vantage centers, the Smart Vantage concept that we've introduced? Like, how would this flow into our revenue, and what is the likely growth that we could see from the segment?
Smart Vantage was a new offering. Thanks, Ayush, for the question. Smart Vantage was a new offering exclusively built for GCCs who are looking for agility and speed. As you know, we are able to deliver offices very quickly. And GCCs will be driving about 40 to 45 million square foot of incremental new office demand in the next 2 years. And in light of this large incoming demand, we have also now tied up with several partners who provide complete end-to-end solutions which a GCC requires. So Smart Vantage will not only take care of the workspace needs, but through our partners, take care of needs of staffing, legal, tax, compliance, onboarding. Altogether, the offering is currently still new and it's in its infancy stage, but we do expect that our current GCC revenue of 15% will likely continue to double in the next few years in light of the new offering that we have launched. And this will not only take care of new GCCs which are coming, but given the large suite of GCC clients that we already have in-house, we are also actively exploring expansion opportunities with them across our pan-India footprint.
Okay, thank you. So I just wanted to clarify the revenue from this Smart Vantage segment. This would come under our normal managed office portfolio business, or would this also come under, an ancillary service or a third party? Like, could it be a new?
It will be coming in the primary revenue already. It will be coming in the primary revenue, not separately.
Okay. Thank you, sir. Just one more point I wanted to clarify. So the center level EBITDA margins, post corporate overheads would come in the 23 to 24% range. Like, what would be a center level EBITDA margin if we factor in the corporate overheads too?
So there are two aspects to.
If you look at the blended central level margins, our normalized EBITDA stands at about 16.4%, with approximately 8% of corporate cost which is coming in. There is also a customer acquisition cost of brokerage that we paid. So if you look at our blended center level margins, they're closer to about 26 to 30%, between 26 to 30%, because there is a mix of mature and immature centers. With more immature centers coming up, they drag our profitability on the center level a little down for the first 8 to 12 months, because that is when your you get the maximum amount of all your costs have started, but your revenues take a little bit of time to ramp up. But despite the high growth that SmartWorks is seeing, you will see that our Margins are still, being sustained, and we've grown from 13.4% in the same quarter last year to more than 16% this year on a normalized EBITDA.
Okay. Okay. Thank you. All the best for your future.
Thank you.
Thank you. The next question comes from the line of Utkarsh Somaiya from Eco Quantum Solutions Private Limited. Please go ahead.
Thank you for the opportunity. I wanted one data point. For the first half of FY26, can you tell me pan-India, the supply and the absorption numbers for flexible workspace? And if it's tier 1, tier 2, you can bifurcate, that would be great. If not, you can give me a pan-India number.
Thank you for the question. Just to clarify, is this for the industry or SmartWorks?
Industry, but you can also give me SmartWorks number. But mainly it is for the industry. I want to understand how strong the demand is versus the supply. Hence, I want absorption numbers and incremental supply numbers.
So look, just to provide you a macro perspective, and the industry estimates vary depending on where it comes from, but office leasing has had a record high over the last few years, and we've seen upwards of 70 million square foot of absorption. Within this, consistently, flex space has been doing more than 20 to 25% of the absorption. So it continues to be a major driver of overall growth of office market, which has been going very steadily. So you can expect very easily upwards of between 15 to 18 million square foot of new flex space absorption every year. So that's the broader macro number. And within this, obviously, you have several players as well as everyone's different strategy based on the supply absorption. So that's the context.
Okay.
And from SmartWorks point of view, we have 1 million square foot of new supply going live in H2 and about 1.4 million square foot of supply maturing during this time period, which will drive incremental margin in H2 for us.
Okay. So you said you expect 15 to 18 million square feet of new flex space absorption each year, like FY26, FY27, FY28. Is that what you meant?
That's right.
And what is the same number for the H1 FY26? See, I have the numbers till March 2025 from the RHP, but from March 25 to September, and can you give me the flex space absorption number for the industry?
It's approximately the same number. There's nothing being published right now, so we'll have to come back on that and we can try to pull that out. But the projection for the first quarter, if you look at the first half of this year, in terms of total real estate demand, the year was projected to be about 70 million square foot. We've already crossed about 48 million square foot in the first half itself. So H1 has seen a significant increase in demand. Typically, H2 does better than H1 in most scenarios, but this time we've seen a significant jump in H1 coming in. Almost 25 to 30% of that has come from flex. So flex, and this might not be the exact number, but this is the predicted number of about 25%, which is there. We can try to pull up some of the industry documents to see if someone has projected the first half of this year and the total flex demand that has come up. But it should be around that 25% to 30% mark.
Would it be fair to assume that the absorption is either equal to or more than the incremental supply for the industry?
So I can comment for SmartWorks, and for us, if you look at our total demand, our committed demand stands at over 88%. So while we are going ahead and growing at the pace at which we are, adding more than 2 million square foot, which we've already done in the last few months itself, still our committed occupancy stand very, very high at about 88%. So while we are taking these assets, we're also seeing customers come and take these assets from us, making sure that our committed occupancy keeps is steady. So yes, at least for us, we can say that the properties that we've taken out of the 18, if we've gone ahead and taken 2 million plus square foot, that 2 million is standing at about 88%, 88% occupancy, committed occupancy.
Okay. Thank you so much and best of luck.
Thank you.
Thank you. Thank you. The next question comes from the line of Saurabh Gilda from JM Financial. Please go ahead.
Hello, am I audible?
Yes, sir.
Yep. Congrats on the signing the largest center in Mumbai. Just wanted to get your comments on the demand for large spaces. You highlighted that the size of deal signings are increasing sharply, and it is also reflected in your 1,000 plus cohorts, contribution from 1,000 plus cohorts. So there has always been a thought that as and when enterprises grow up and to a point, it may make sense to switch from a flex to a conventional office center, but that's clearly not the trend, given your numbers and your comments on the size of the deals that are taking place. So if you can just throw some light on what's the thought process from a tenant perspective in terms of signing a flex space.
No, absolutely. I think, tenants are not just looking at flex space as a option till they get to a critical scale. If you look at SmartWorks campuses, while Hiranandani building in Vikhroli is now our largest campus, but we have multiple campuses which are already operational, standing at 90+% occupancy across the country. We have buildings like AP81 in Pune, Malpani Agile in Pune, 43Q in Pune, Vaishnavi Tech Park in Bangalore. These are all massive assets of 650,000 square foot plus buildings in which more than 10,000 people come on a day-to-day basis to work. So these assets are something that SmartWorks has created this model in which our ability to take up these buildings, transform them into campuses. So when a customer comes and takes space in this building, they're not just looking at flexibility. They're looking at getting value for the value pricing in terms of costing. They're looking at getting a standardized experience for their employees across different cities. Whether they take 200 seats in a location or 1,000 seats in a location, their employees will get access to the similar size of a gym, crash, cafeteria, all of the common amenities that are required. So while flexibility is typically there in co-working and in back-to-back deals, with SmartWorks, most of the tenants who are coming are looking at us as pan-India partners, scaling their businesses across or offices across India and moving them into SmartWorks centers. How I can, demonstrate this is, if you look at our numbers, we have only 760 clients currently, which is a much smaller cohort of clients. While 760 is a large number, but it's much smaller compared to a lot of co-working demand that comes where the number of clients might be in thousands. So our clients look at SmartWorks as a pan-India partner. They're moving not only their offices in a particular city, but they're moving their pan-India portfolios into SmartWorks centers just because of the pricing, just because of the flexibility, because of the amenities that their employees are getting, and the fact that we can give them that scalability option to grow from 100 to 1,000 to 2,000 within these campuses or within campuses of SmartWorks, where they don't have to worry about managing and running their offices anymore. So this metrics is something which is very, very unique to SmartWorks.
So, got it. And just as a follow-up, when you say contribution of 1,000 plus has increased, so it may not necessarily mean that this 1,000 plus is at one location, right? From the same client at a different across your portfolio.
So typically,
it is in multiple cities.
It is in the same location, but there might be deals which are 1,000 plus. The same client might be sitting in two different cities with 1,000 plus seats. So it is a mix of both.
Okay, got it. Understood. And just a final question. You also mentioned that you have also started signing up.
Thank you, Mr. Saurabh. Please rejoin the queue for further questions.
Okay.
Thank you. The next question comes from the line of Vandit Jain from Sage One Investments Manager LLP. Please go ahead.
Yeah, I have just one more question. Around the blended per seat rental that we're getting, it stands at around 7,500 rupees, 7,500 rupees for the occupied seats. So with the churn that we have seen in this quarter, do you think that number could go up or any color on that?
From a per square feet pricing perspective, our blended revenue realization stands at approximately 175 rupee as far as Q2 FY26 is concerned. When you look at our numbers in in the past year, say for example, in the last year, say it was around that 160-65 kind of a mark?
So on a go-forward basis, as a function of increased occupancy as well as the rentals reflecting the current market reality, you should expect to see the realization per square foot continuing to go up.
Okay. Got it. Thank you.
Thank you.
Ladies and gentlemen, due to time constraint, that was the last question for today's call. I would now like to hand the conference over to Mr. Harsh Benani for closing comments.
Thank you very much for attending our second earnings call after listing. We are very grateful for your time, and we've this time also shared an additional shareholder letter, which we thought will answer a lot of the pressing questions that you might have on the industry as well as on SmartWorks. So this is our humble attempt to address some of those perspectives, and we look forward to continuous robust growth in the coming quarters and again engaging with you for our next earnings call. Thank you very much.
On behalf of Kotak Institutional Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.